Stock markets are no longer just battlegrounds for human investors. They're arenas dominated by high-speed trading algorithms that can execute thousands of trades in the blink of an eye. For retail investors, this raises a troubling question. Are these systems designed to give big institutions an unfair advantage? While algorithms promise efficiency and liquidity, critics argue they exploit speed, access to information, and loopholes that ordinary investors can't match. Every split-second decision, every hidden pattern, seems to tilt the playing field. In this article, we'll explore how trading algorithms operate, whether they are stacked against the little guy, and what it means for the future of fair investing. In today's financial markets, trading is no longer a slow, deliberate process. It has become a race measured in milliseconds. High-frequency trading algorithms dominate the landscape, executing trades faster than any human could. For retail investors, this can feel intimidating, even unfair. These algorithms analyze vast streams of data, detect patterns, and react instantly to market movements, often capitalizing on advantages that ordinary investors cannot access. Critics argue that this creates a system tilted in favor of large institutions, raising questions about fairness, transparency, and market integrity. But are these algorithms truly rigged against retail investors, or are they simply a reflection of technological progress in finance? In this article, we will break down how trading algorithms work, examine the advantages and disadvantages they create for different market participants, and explore regulatory and ethical considerations. By the end, you'll understand whether retail investors are truly at a disadvantage, or if there are ways to level the playing field. Trading algorithms are computer programs designed to execute financial transactions automatically based on predefined rules. Unlike human traders who make decisions using intuition or experience, algorithms rely on data, speed, and mathematical models. They can process massive volumes of information, from price movements and order book data to news headlines and social media sentiment within milliseconds, identifying trading opportunities faster than any human could. There are several types of trading algorithms. High-frequency trading, or HFT algorithms, execute thousands of trades per second to capture small price differences, often profiting from the tiniest market inefficiencies. Trend-following algorithms detect patterns in price movements, buying or selling when a stock appears poised to rise or fall. Other algorithms use arbitrage, exploiting price differences across markets, or sentiment analysis, reacting to news and social signals before humans can respond. While these systems bring efficiency, speed, and liquidity to markets, they also create challenges. Their rapid execution can amplify volatility, and access to sophisticated algorithms often requires expensive infrastructure, putting retail investors at a potential disadvantage. Understanding how algorithms operate is the first step towards evaluating whether the system is fair or inherently stacked against everyday traders. One of the biggest challenges facing retail investors today is the widening gap between them and institutional players. Large banks, hedge funds, and trading firms have access to sophisticated algorithms, high-speed networks, and vast amounts of data, resources that most individual traders cannot match. This disparity creates an environment where speed and information asymmetry often determine who profits and who loses. High-frequency trading firms, for example, can execute thousands of trades in milliseconds, capitalizing on tiny price movements before retail investors even see them. Institutions also benefit from co-location services, placing their servers physically close to exchange systems to reduce latency. Meanwhile, retail traders typically rely on standard brokerage platforms with slower execution speeds, putting them at a structural disadvantage. Additionally, institutional algorithms are constantly updated using machine learning, adapting to market behavior in real time.
Retail investors rarely have the tools or knowledge to compete with this level of sophistication. While retail participation is increasing thanks to apps and low-fee platforms, the technological and informational gap remains significant, fueling concerns that the market is skewed in favor of those with the deepest pockets and fastest machines. Market makers play a crucial role in modern financial markets, providing liquidity by continuously buying and selling assets. However, their position also gives them unique advantages that can put retail investors at a disadvantage. Market makers often use sophisticated algorithms to predict order flow, anticipate price movements, and adjust their strategies in real time, tools that most retail traders cannot access. These algorithms can detect large orders, analyze market sentiment, and exploit tiny price discrepancies across multiple exchanges. By doing so, market makers can profit from volatility and execute trades before retail investors have a chance to react. In addition, practices like payment for order flow, where brokers route retail orders to specific market makers, can create conflicts of interest, potentially leading to slower execution or slightly worse prices for the individual trader. While these systems increase market efficiency and liquidity overall, they also highlight structural asymmetries. Retail investors often operate at the mercy of speed and access disparities, making it challenging to compete on equal footing. Understanding the hidden advantages of market makers is essential for recognizing the dynamics that shape everyday trading outcomes.
The question of whether trading algorithms are rigged against retail investors is complex. On one hand, high-frequency trading, market-making advantages, and access to massive data sets create a system where speed and resources favor institutional players. Retail traders, with slower execution speeds and limited data, often face structural challenges that can feel unfair. However, rigged implies intentional manipulation, and the reality is more nuanced. Algorithms are designed to maximize efficiency, reduce transaction costs, and provide liquidity. Market makers and institutional traders are operating within legal frameworks and exchange rules. The asymmetry is often a byproduct of technology and capital rather than deliberate sabotage of retail investors. That said, conflicts of interest, like payment for order flow, can create scenarios where retail traders receive slightly worse execution prices or slower fills. Flash crashes and sudden volatility, often exacerbated by algorithms, also disproportionately affect smaller investors who cannot react as quickly. Ultimately, while the system heavily favors those with speed, capital, and technical resources, it is not explicitly rigged against retail investors. Awareness, education, and strategic use of available tools can help retail traders level the playing field and navigate these complexities. While institutional players hold significant advantages, retail investors are not powerless in algorithm-driven markets. Success comes from understanding the landscape, using available tools wisely, and focusing on strategies that do not rely on speed alone. One key approach is long-term investing. Algorithms excel at short-term trades, but retail investors can leverage patience and a focus on fundamentals to minimize the impact of high-frequency market movements. Investing in index funds, dividend-paying stocks, or diversified portfolios reduces exposure to short-term volatility and algorithmic trading strategies. Another strategy is using technology to your advantage. Many brokerage platforms now offer algorithmic tools, real-time data, and advanced order types, enabling retail investors to automate certain trades, track market trends, and execute more efficiently. Education is equally critical. Understanding market mechanics, reading financial statements, and staying informed about regulatory changes empowers retail traders to make strategic decisions rather than reacting emotionally. Finally, collaborating with professional advisors or joining investment communities can provide insights and shared knowledge, further leveling the playing field. While retail investors cannot match the raw speed of institutional algorithms, they can compete successfully by focusing on strategy, patience, and informed decision-making. Trading algorithms have transformed financial markets, giving speed, precision, and data-driven decision-making to institutional investors. These systems can execute thousands of trades in milliseconds, analyze vast datasets, and capitalize on opportunities before retail investors even have time to react. On the surface, this creates a landscape that seems heavily skewed against individual traders. However, the system is not explicitly rigged. Most advantages come from technology, capital, and access rather than intentional manipulation. Retail investors face structural challenges, but they can compete by leveraging strategies that prioritize patience, research, and fundamentals over speed. Long-term investing, diversification, and the smart use of brokerage tools allow individual traders to navigate markets effectively. Education, awareness of market mechanics, and disciplined strategies are key. Ultimately, while algorithms favor those with resources and speed, retail investors who understand the rules, embrace technology, and focus on informed decision-making can still achieve meaningful success in today's complex markets.